A number of those factors that were really pressuring prices lower over the past 18 months or so have actually reversed now. And that's hugely positive for gold. The dollar was a huge drag, Fed hiking was a huge drag, but also there's a couple of really key developments underlying the market that's supporting prices on the downside. Firstly, central banks are buying. We estimate buying will be the strongest at least since 2015, if not further. And also ETFs have become much more resilient as well.
So as we talk about those ETFs, that's the way that many investors are going into it, whether through the miners or through these physical ETFs themselves that hold actual gold. As we talk about the way that the markets are developing globally, we are seeing signs of a slowing economy, not just here, but emerging markets as well. How much of that emerging markets demand had been powering gold prices over the course of the past couple of months?
So it's interesting that EM demand has actually been quite weak. Our normal two key drivers are India and China, and we normally look to them to provide the floor for gold prices. But India's demand was very weak, especially around Diwali, and China's demand has only just started to pick up. So we tend to see buying ahead of the Lunar New Year, but that buying started in December, offering a better floor for prices. But that hasn't been the key driver for gold, not in the past few months.
What has been the key driver then?
So it's been the turn in the macro environment, certainly the dollar. But I think what's really interesting does come back to the ETFs. So ETF holdings are now at a 6-year high. But if we go back to 6 years ago, most of those holdings were concentrated in North America, in the US in particular. But now the US has been redeeming, but Europe has still been a steady buyer. And now most of those holdings are concentrated in Europe, around 70%. And European investors tend to be more resilient and longer-term holders.
There used to be a time, and maybe it's still happening right now, there used to be a time when gold was viewed as a haven asset. In your mind, has there been any kind of a demand push over the course of the past couple of months just because of the market volatility that we've seen, not just here, but abroad as well?
That's been important for gold. Gold was questioning its gold safe haven status over the past year. But over the past few months, it's actually come back alive again. And the equity market volatility, the correction that we saw in the US, and also heightened concerns about Brexit have seen a lot of investors coming back into the gold and, importantly, reassessing the market as well. So across the investor space, gold is relatively underheld across the whole space as a whole. And now investors are starting to look at it again.
You mentioned that emerging markets, actual physical demand from people used to be a big driver of it. ETFs are still a big driver because they have to buy physical gold to back their holdings. So talk to us about the prospects for physical gold versus financial gold products. Which is the more attractive for investors right now?
I'd say from the physical point of view, gold still looks a little bit lackluster. We do expect China's demand to stabilize somewhat, but not be a huge driver, not in terms of providing support for gold prices. But if we look at the financial aspect for gold, it's starting to look much more attractive. We expect the dollar to weaken over the course of this year. The Fed is being much more patient and is on hold, and we don't expect a hike in March or in June. And yields have stabilized somewhat as well. And I think the fact that gold is reasserting its safe haven status makes gold as a financial play much more attractive in the current environment.